Hello, everyone. Welcome to our webinar today, Know Your Nexus, How to Avoid Costly Tax Traps and Stay Ahead of Compliance Risks. Today, we are joined by one of Avalara's renowned tax experts, Scott Peterson, to dig into what Nexus is, how it's triggered, and what it all means for your tax obligations. Now, before we get started, just a couple of disclaimers very quickly. Scott, if you want to go to the next slide. Thank you. So I first have to get out of the way a quick disclaimer that Avalara cannot provide legal tax advice. So everything that we discuss during today's webinar is for educational purposes only. But as always, we'll do our best to answer your questions as best as we can. And then if you want to move one more slide forward. So you'll see on our screen our safe harbor statement. I'm not going to run through this. If you want to read through this, you certainly can. But this just says that, again, this information is for informational purposes only. Anything that we say regarding Avalara is confidential information and may change. So be aware of that. All right, and then if you want to move one more slide forward, Scott, and then I'll pass it over to you. But as I mentioned, we are joined by Scott Peterson. He is Avalara's Vice President of Government Relations, and today he is going to go over everything Nexus. So Scott, I'll hand the mic over to you.
Thank you, Courtney. Good morning, good afternoon, good evening. Welcome to Avalara's conversation about Nexus. This is I've been doing this a long time, and I can arguably say that this is the one constant in all the years that I've been doing tax administration and tax policy. Nexus is always the key to whether or not someone has an obligation to collect tax. And that is actually the definition of Nexus. You have an obligation to collect tax. So we're going to talk about what it is and why it matters, some common Nexus pitfalls, some customer stories and case studies. Then we're going to talk a little bit how we can help you. And then we'll have a few questions if you have them. So Nexus 101. Like I said, Nexus is this word that means you have a connection with something. You and I have a nexus today because we have a connection. Courtney and I have a nexus because we do webinars all the time together. From a state sales tax, state income tax perspective, nexus is that word that means that you have enough connection with a government that the government has the legal right to make you do something. They have a legal right to enforce their laws upon you. So when we talk about nexus, we talk about something that has happened, almost always something that you have done that gives that government the right to expect you to understand and to follow the law. Nexus historically in sales tax has been something around being physical. For the longest time, the only way that a state could force you to do something, force you to follow their law, is if you were physically present inside that state. This is the list of things that over the last 60 years have come to mean what it means to be physical. Locations. If you have a store, a warehouse, a thing of some form or another inside of a state, you are physically present inside that state, and they have the right to impose their laws on you. Maintenance or service repairs. If you contract with somebody to do something for you on your behalf inside of a state, that person is physically present in that state, and that person, because of the arrangement you have with them, that person creates physical nexus for you. Owning or leasing real property. It could be bare land. Now, bare land's a little complicated, maybe a bad example, because bare land can be something entirely unrelated to your business. And if such, then I would go to the Department of Revenue and say, okay, yeah, we own 160 acres of land out in the middle of your state, and we have no idea what we're ever going to do with it, if we ever do anything with it all, but it has absolutely nothing to do with us making sales into your state. Does that constitute physical presence? That would be a question. I'd get my lawyer or my CPA and I'd say, yes. Physically present? No. It has nothing to do with sales. Otherwise, owning or leasing real property kind of has this colors your relationship with that state. Hosted data centers, which is a little funky, but what it is, it's leasing real property. A data center is real property. The computers inside of a data center are real property, as are their tangible personal property, if not, depending on the size and how they're connected to the real property. And as such, if you are leasing them, you have a physical presence inside that state. Now, that's an area where states kind of differ from each other once in a while. There are states that want data centers, and so they might give the people who are leasing space in that data center a break from this particular issue, but it's still one of those things where you have to get your CPA or your attorney to do the research for you and to find out. Field sales service staff. This goes along with maintenance, service, and repairs. If you have employees inside of a state, the presumption is that they are physical. Haven't yet met an employee who isn't. As such, they create physical presence for the company. The rare occasion when they're doing something completely unrelated to sales is worth asking the state about. If you've got your HR department inside, if you have one person working from their home office doing HR stuff for you, maybe not, they don't constitute physical presence because they're not there to help you build and maintain a market. Always use that phrase, build and maintain a market. Otherwise, if you've got salespeople in a state, you've got repair people in a state, you got people in there doing service stuff, you got people in there making service calls, those people are all physical presence and they create a nexus for you with that state. Licenses, royalty fees, franchisees can be very problematic. The presumption with franchisees is that you very likely have something of your own inside that state. And this was an issue that when I was with the sales tax in South Dakota, we went through a couple years of addressing non-compliance with franchisors. And there were a number of things that we discovered when you walk into a franchise operation. You don't know what's owned by the franchisee and what you don't know what's owned by the franchisor. And often there's things inside that franchise that is owned by the franchisor. And as such, that creates physical presence for the franchisor, and the franchisor is doing something in that state that generates income or generates sales that are unrelated to what the franchisee is doing on their own behalf. Then that presence of that franchise very likely creates a physical presence. Direct or online sales, I'll get to that in a second. Third-party owned warehouses, yeah, it's true. If you store property inside of a someone else's warehouse, you have physical presence inside that state. No question about it. And this is something that catches people today because of the invention and the breadth of the amount of marketplaces. And for those marketplaces that will store your property and ship your property off to the ultimate consumer, wherever you have that property stored, that's physical presence. And they have nexus because they're physically located there, and everybody who has property stored inside that warehouse also has physical presence and nexus. Now, affiliates, trade shows, commissions to resellers, investors, board members, marketing, web advertising, probably not, but it gets a little funky. Drop shipments, really funky, but pardon me, I'm getting over a nasty virus. Drop shipments are an issue. Historically, drop shipments would have created a problem for most sellers. No, historically, drop shipments created a problem for the drop shipper. It's still a problem for the drop shipper, but because of the 2018 Supreme Court decision in South Dakota versus Wayfair, the drop shipper now has less of a problem, or it's an entirely different kind of problem, because most retailers now have to collect sales tax, and which should lessen the tax burden on drop shipping companies. Maintenance contracts are like maintenance, service, repair staff, and then remote sales. Remote sales today is what most of us focus on. Sometimes we focus on it too much because we forget that physical presence still exists and that physical presence will create nexus for you. Whereas remote sales creates nexus. That, like I said, that's the South Dakota versus Wayfair decision from 2018. In that decision, the Supreme Court said that they made a mistake in 1967 when they said that physical presence was the only standard that states could enforce. And they just simply repealed it. They said, we made a mistake, and it's not the case anymore. It's still the case because physical presence creates nexus. Nexus creates an obligation to collect sales tax. Today, you can have nexus, an obligation to collect sales tax based upon the based on the sales that you make inside of a state. In the old world, physical presence, you decided when you were going to have to collect some state sales tax because you decided where and when you were going to be physically present inside of a state. Under the remote sales category, your customers decide where and when you're going to have to start collecting sales tax in a new state. And we'll spend some time here talking about that. Here's the decision. Every state in the country, plus the District of Columbia and Puerto Rico, have adopted a law virtually identical to the law that South Dakota had in place when they sued Wayfair. The Supreme Court ruled in favor of South Dakota, eliminated the physical presence standard as the only standard. So it opened the world up to alternative standards. The alternative standard that South Dakota had in effect in the law that they sued Wayfair on is if you make more than $100,000 in gross receipts from sales into South Dakota, or more than 200 separate transactions from sales into South Dakota in the current calendar year or the preceding calendar year, you have an obligation to get a license and start collecting tax. That is the essence of economic nexus. This simple sentence is what completely overturned the previous rule, the rule that had been in effect for over 50 years, and imposed and exposed everybody in the world to an obligation to collect sales tax everywhere. When the case was decided on June 21st, there were 9 states that had the law in effect. And at that moment in time, every retailer in the world had 9 days notice to prepare to start collecting sales tax in those 9 states. Kentucky, Vermont, Hawaii, South Dakota, their law was in effect, but what the Supreme Court did was send the case back to South Dakota court system and tell them to come to a conclusion that matched what the Supreme Court said. So South Dakota, even though it was their law and their law was technically in effect, it didn't get to go into effect for several months because South Dakota was still in court. But all the other states that had adopted that law had the legal right all of a sudden to require everybody in the world to start collecting their sales tax. And as you might imagine, no one was ready. Those states weren't ready. No one was ready. One of the things that made this really complicated was South Dakota's tax structure. One of the reasons why most states liked the fact that South Dakota was the test case is because of South Dakota's tax structure. They don't have an income tax. All they have is a sales tax. So they were one could feel sorry for them if you were the court, because if we don't help them with this tax, they don't have a tax structure other than this tax. They'd have to impose an income tax on their constituents, which of course they could have done, and they talk about doing it all the time, but they never do. But the other thing that the other states liked about South Dakota is South Dakota's a state that taxes everything. And they have almost 300 cities and tribal governments that have a sales tax. So it's very complicated in that they tax everything. Very complicated because there's lots and lots of local taxing jurisdictions. And most of them are cities, which means that the boundaries are movable and changeable. and they change and move all the time. It's not like Wyoming or Ohio, where the sales tax is based upon a county boundary, which never change, and they're exact. There's no annexations, there's no de-annexations. In South Dakota, those city boundaries change all the darn time, which is one of the things that make economic nexus really complicated. So this map shows you economic nexus thresholds. So I told you $100,000 or 200 separate transactions. The $100,000 in the 200 transactions are what we call threshold. That's what, when we talk about threshold, when you hear someone say economic nexus threshold, they're referring to that dollar amount of sales that you get to make into a state before you have an obligation to start collecting your sales tax. So South Dakota's law says $100,000. That means that if you sell, that you can sell $99,999 worth of stuff in South Dakota in a calendar year and not have nexus, not have an obligation to collect sales tax. You sell $100,000 and or more, you then automatically have nexus and obligation to start collecting their sales tax. So when you think of economic nexus, think about that threshold as a literally a threshold in walking into a house. When you step over the threshold, you have subjected yourself to the rules in place in the new room you've stepped into. You walk into somebody's house, you live by their rules. You go over $100,000 in sales in South Dakota, you live by their rules. You stepped over their threshold. You can see that there are a few colors on this map. We've got Oregon, Montana, New Hampshire, and Delaware that don't have a sales tax. Those states, there is no economic nexus because they don't have a sales tax. You see the California and New York, which are dark blue. Those states have $500,000 in nexus. When they decided to pass this law, they said we are so much larger than South Dakota that $100,000 is not a practical number for us. So they chose 500,000. You can see New York is a dark color, but it's an entirely different dark color. That's because they have $500,000 and 100 transactions. So to qualify, you have to have more than $500,000 in sales, plus they have to be in 100 different transactions. So it's arguably harder to have nexus in New York than it is in most places in the United States. The light blue let's take the colors here in Nebraska and South Dakota. The difference between the two of them is the 200 transactions. There's a movement around the country to eliminate the 200 transaction component or the transaction component at all because it creates odd outcomes. You can sell 200 things for $1 each and have to collect sales tax in South Dakota, and you sold $200 worth of stuff. If it were just measured by sales, you could sell $99,999 worth of stuff. So states are moving away from the threshold, the transactional threshold, because it creates just bizarre outcomes. What this map doesn't show you is what's really complicated. This map may look complicated, but it's not. What's really complicated about this map is the definition of sale and taxability. And, well, let's do three things: definition of sale, taxability, and local governments. South Dakota taxes everything. Well, one of the reasons why all the other states thought they were a good test case. They tax everything. That means they tax everything. They tax accountants, they tax engineers, they tax architects, they tax lawyers, they tax all kinds of services. They tax every kind of services except education and healthcare. They tax all kinds of software. They don't care how the software gets delivered to you or how you access it. It doesn't make any difference what you do in South Dakota. If you sell tangible personal property or services, it's almost certainly subject to tax. North Dakota, on the other hand, is the exact opposite. That's a state that does things by taxable sales. And they don't tax any services. So North Dakota and South Dakota came into the United States exactly the same time. Their sales tax looks a little bit like each other, at least at the very beginning, but not afterwards. And they are radically different when it comes to how their sales tax applies. Now, both of them have lots of local governments. Most of them have lots of cities with a sales tax, Both of them have tribal governments with a sales tax. But North Dakota taxes so few services that if you're in the business of selling services to somebody, you will almost certainly have to get a license in South Dakota, and probably never have a license in North Dakota, even if you sell the exact same thing to exact same people. And this spreads around the United States. So that those two are an extreme example because of South Dakota. North Dakota is much more like the rest of the country. North Dakota and Idaho have virtually identical sales taxes. They don't tax a lot of services. They just tax a lot of tangible personal property. The rest of the states are a mixed bag. New Mexico's sales tax is almost identical to South Dakota's. Hawaii's is almost identical to South Dakota's. Alaska's, they don't have a state sales tax, but they have 115 cities and counties in Alaska that have a sales tax. Their sales tax is much more like North Dakota's. All they tax is tangible personal property. So when you're thinking about nexus, remember you need to think about the threshold. You know, threshold is like the doorstep, the threshold from the outside to the inside. You step over the threshold, which means you've gone over the dollar amount, or you exceeded the number of transactions, and you've stepped inside their world, and their rules apply to you at that moment in time. So how do you know if you have nexus? There are several types, as I've described, and I'm going to start here on the end, on the right, on the physical presence. Do you have employees? Do you have inventory? You have kiosks, offices, stores, trade shows? Do you attend trade shows? If you're attending, the word attending presumes physical presence. Warehouses or other physical ties. So if you have them, you have to presume that you have nexus. Now, what you have may not be the type of nexus that creates an obligation to collect sales tax, but you won't know that until you've gone in and asked them. And I certainly recommend this is when you start getting professional advice. Economic nexus, all about sales. All about sales. Have you made enough sales into a state where that state can have the right to make you collect sales tax? And we talked about the map. The map tells you what the thresholds are. They don't tell you necessarily whether or not you have to start collecting sales tax. And the thresholds don't tell you if what it is you're selling is taxable, or if whom you're selling to are taxable. Those things vary a lot. But once you've gone over that threshold, you know you need to start asking the same kind of questions that you asked when you had physical presence. Click-through nexus is an entire click-through and affiliate nexus are two forms of physical presence that are in place today because of that interim period between when physical presence was the only test and where we are today when we have economic nexus and physical nexus. Click-through nexus is when it's a marketing program. So you find somebody inside of a state that has a following inside the state, and you enter in an agreement with them whereby you get to put a link to your website on their website, and if somebody is on their website and clicks onto your website, they're clicking through to you, and then you pay that initial website owner a commission based upon what somebody buys when they click through. The states say, and this is probably 15 states that have this law, that say that the fact that you've clicked through and you have an agreement with them means they are your agent. So click-through is really just agent relationship. Old law, kind of a new take on an old law, because it's taken this concept of the internet, whereas it used to be just I have a contract with you, you're gonna do something for me inside of a state, and I'm gonna pay you for it. And if I didn't have the contract with you, I'd have to be there myself. So that's kind of what click-through is. Affiliate is different. Affiliate is a law that says if any member of an affiliated group of companies has physical presence, every member of the affiliated group has nexus. Fewer states have this law. In some ways, it's questionable whether or not it has any value anymore, but there are still a few states that have this law. And it's really important to look at this law and ask your professional advisors if the states have that law, because that could catch you on corporate income tax that you hadn't anticipated. I mean, it's intended for sales tax purposes, but these laws sometimes get stretched beyond their original purpose. Okay, there are 13,000 sales tax jurisdictions in the United States. There's actually more when you add in lodging taxes and meals and beverage taxes. There's several thousand cities and counties in the United States that have a lodging tax. They don't have a sales tax. We care about that because we're in the lodging tax business in addition to the sales tax business and the food and beverage business, the alcoholic beverage business as well. So when you think about 13,000 tax jurisdictions, think, okay, well, that's true unless you're in the lodging business, then it's probably more than that. The reason we mention this is because the majority of those are cities. And cities have that one thing I told you about earlier, their boundaries change. And so in addition to knowing what the rate is, each of them has a different rate. Sometimes the rates can change, sometimes they don't. South Dakota, the maximum rate that a local government can have is 2%. And the overwhelming majority, almost all of the cities in South Dakota are at their maximum rate. So we don't ever expect to see we rarely see rate changes at the local level in South Dakota. Other states you see a lot because they have more flexibility and or they're a long way from whatever the state's cap is on them. But where we do see a lot of change is in their boundaries. And in most states they put a limit on the effective date for sales tax purposes on boundary changes. Often it's twice a year. In a few states it's every quarter, which means that you, city, can change your boundaries anytime you want to. But for sales tax purposes, it's only going to be effective on July 1 and January 1, or the first day of a calendar quarter. Everybody has to give notice. Sometimes they don't. Sometimes it's very hard to know when there was a change. Sometimes the states don't even know when there's been an annexation, which really makes it one of the more complicated things about sales tax administration is the lack sometimes of transparency at the local government level about their changes. Now, from a taxability perspective, most states force their local governments to tax the same thing. There are some areas where it's different. Colorado's radically different. Louisiana's different. Alabama's different. Arizona, it's different. Alaska, it's different by design because there is no state tax, so everybody gets to do whatever they want. That the rest of the country, most things are alike. So we know that whatever is taxable in Rapid City, South Dakota, for the city's tax is exactly the same thing as taxable in the state of South Dakota. Likewise in Minneapolis or in Denver, not Denver. Denver's a bad example. Almost made a mistake there. Salt Lake City. New York, it's mostly the same. Where we see some differences in New York are thresholds. New York and New York City both exempt clothing to a certain amount, but they have different thresholds. So you can buy a certain amount of clothing in New York and New York City exempt from sales tax, but the threshold for each differs. So it's $100 here and $175 here. It can be very, very complicated if you're in that business. So common pitfalls. These are things that you maybe you didn't think about, or maybe your tax professional wasn't familiar with. Just don't know what triggers nexus. You don't know that having $103,000 for the sale in Wyoming means you have nexus. It means you need to be collecting sales tax on all the sales you make into Wyoming. You didn't realize that having a contract with a computer repair company to repair the computers that you sell to somebody in Wyoming is an agency relationship, and that's the same thing as if you had gone into that state yourselves and repaired that computer. You know where you make sales, but you don't always know where your salespeople are. We have lots of salespeople at Avalara. I hope our internal tax accounting team knows exactly where they are. I'm pretty sure that's probably not always true. We know where they're based, but we don't know on Tuesday whether or not they're in Chicago or in Peoria. We know they're in Illinois because that's where they're based. So you know you've made X number of sales into Illinois. You know you've got salespeople in the Midwest. You don't always know where that salesperson is at that very moment in time. Or the person that does know where that salesperson is not the tax department. Tax department knows where you're making sales. Tax department doesn't necessarily know where all the people are at any given time. So HR and sales and tax have to talk to each other because these things matter. Otherwise, you, the tax department, only get a partial picture of what it takes for you to have nexus. You file and you forget. Oh, every state in the country does, they do a lot of things alike. Often they're slightly different, which makes it very complicated. But one of the things they always do is they all have annual filing. So they put all small retailers or retailers that don't make sales but have an obligation to have a license on an annual filing status, which means they file one sales tax return a year, the December return, and it's uniform. It's always the same one, the December return that's due in January. It is shocking how many people get a license because they're told they have to have a license. They don't make any sales. They need to be able to give a resale certificate to one of their suppliers or one of their buyers. And they have that sales tax license to be able to give that resale certificate to people. They forget that that sales tax license comes with an obligation to file one return a year. So February in the Department of Revenue in this country is busy because February is when, and January is also when they file, all the returns are filed. So you have all your annual returns, you have your semi-annual returns, you have your quarterly returns, and you have your monthly returns. So here at Avalara, we call that our World Series because that's when we file all the returns that we have to file in a year, get filed at least once in January. Well, if you're that person that has a sales tax license because you need to be able to give a resale certificate to someone, you're going to forget that in January you got to file a sales tax return. And you may have this license in 25 states. So you end up having to file 25 different sales tax returns. This draws attention. So if you go on and you go on and you go on and you never file a return, or every year you're late filing that return, somebody's eventually going to call you and say, you know, I think we should talk. You mind if I send one of my auditors over to visit you? And that auditor shows up, and of course you don't get any choice in the matter. They're only kidding when they said, do you mind? The auditor shows up, the auditor says, I need to look at some records of yours. Can we go back? Can you give me all your purchase and sales invoices for the last 3 years? Now, the good news, if you have a license, you limit how far back the state can look because there's a thing called a statute of limitations. The bad news is they can go back 3 years, 3.5 years, 4, in one state, 4.5 years. That is an opportunity for them that was created because you forgot. One state bias. That should say bias. One state bias should say bias. This is a horrible mistake. I told you that South Dakota has basically the same sales tax as New Mexico and Hawaii, but they're radically different from North Dakota's. So if you're based in Wyoming or you're based in North Dakota, and all of a sudden you have your online business is going gangbusters and you start having millions of dollars in sales in every state around the country, and you mistakenly think that every other state is like North Dakota, you're going to have a very unpleasant future. Lots of states are like North Dakota. Lots of states are radically different. That means that if you believe that because what you sell in North Dakota is exempt from sales tax in North Dakota, that it's exempt from sales tax in South Dakota, you're almost certainly going to be wrong. And very likely you're going to be wrong in 15 states. So don't fall into the trap of assuming that what you know is all you need to know. What your tax attorney and what your tax CPA know is all they need to know, because that's not the case. You have to know everything about everywhere, because they're radically different from each other. The sales tax return in New Mexico is bizarre. The one in Arizona is even worse. They don't even call it a sales tax. Arizona's called the transaction privilege tax. It's a gross receipts tax. Don't call Hawaii and want to talk about their sales tax. It's a gross receipts tax. They'll let you go on for 3 or 4 seconds before they say, sir, we don't have a sales tax. And you say, yeah, you do. They're going to say, no, sir, we have a gross receipts tax. So when you see that happening, remember, what you believe you know isn't necessarily all you need to know. So just a couple customer stories as a way of kind of, going in a little more detail than what I just said. So challenge 1, suspected tax obligations in multiple states, but customer lacked clarity on where nexus was triggered or if they were delinquent in tax collection. This is it's going to happen when you outsource your sales tax to an accounting firm or a law firm, or frankly even somebody like us. You're not paying enough attention to where you're doing business and where you're licensed in collecting tax don't always match up. And this really is an issue, and certainly this is an issue when you first realize that you have nexus somewhere. You probably have nexus somewhere else too, and that may be because of the sales you made in this state are exactly the same number of sales you made in the adjoining state, and they both have the same economic nexus threshold. Or you find out that you have salespeople in that state and you didn't realize you had them in there. So what this does is expose you to the audit. In a situation like this, so when I explained South Dakota's law, I said in the current calendar year or the preceding calendar year, these laws went into effect for the most part in 2018 and 2019. So let's say Kentucky's law. Kentucky's law went into effect in 2018. Their law says $100,000 in sales in 2018 or 2017. And that's the way all these states' laws work. And what that means is they're going to ask you about your sales in this year, but they're also going to ask you about your sales last year. If you exceeded the economic nexus threshold in the year before, they're going to make you get a license and pay that tax that you should have collected. They'll have your records because that's a requirement for doing business in the state. And whether you like it or not, once you've exceeded economic nexus, the states have the legal right to say you're engaged in business in my state. And as such, all the rules I have associated with record keeping and all the other things, they go into effect and they can enforce them on you. Unclear on nexus obligations. This is one that goes into, in this particular case, they were registered in multiple states without confirmation, overlooking historical tax liability. So they hired somebody to register with them. They said, okay, if I get a registered in Wyoming, I probably have to register in Minnesota, in Washington, and Utah. So I'll just go ahead and get registered, and I'll start collecting on July 1st, and we'll call it good. Well, that is a great idea, unless, and it's a great idea unless somebody comes in and says, okay, well, I thank you for registering and collecting starting July 1 in 2025. But when I look at your records, I see that you exceeded our economic nexus threshold in 2024, and you should have been collected in 2024. That's when they're going to go back and look at your historical tax liabilities and make you pay sales tax on all those sales. And it's very hard to get sales tax from your customers 18 months after you've billed them and they've paid you. So let's talk a little bit about how we can help. Obviously, automation. The key to keeping up with all these changes is to work with somebody that's keeping up with all these changes. And that's what we do. Our job here is to know exactly what and when changes are made at a state or by a local government. It gets very complicated keeping up with the local governments. We have these relationships with states that we hope gets us by, but we also have lots of relationships with local governments. Actually, artificial intelligence is making this job a little bit easier because we can now search easier than we were able to do before. But nonetheless, this is still a very hard job. We have this free Nexus tool that you can come in and use that might give you a feel for where you are exceeding a state's economic nexus threshold, or you're getting close. And if you're a customer of ours, we have a heat map that we have in effect that does exactly that. It shows on this heat map where you're making sales and where you have a license, and where you're making sales and you don't have a license. And it changes colors based upon, at least on the unlicensed side, where we're concerned that you might meet some state's threshold and have an obligation to start collecting. Voluntary disclosure. So I talked about having liabilities that you weren't aware of. One of the things that you want to do is before you start getting registered anywhere, talk to a professional about what it means and let them look at your history. Let them evaluate whether or not you're going to be asked questions by that state when you get a license that are going to harm you financially. It happens all the time. Rarely does someone get a license in a state that just started business that day. Everybody has them. Everybody started business 2 years ago. They've been making sales everywhere. They're making sales anywhere. And as such, no one really walks into a new state without any past. Everybody has a past. The way to deal with the past in a very managed perspective is what's called a voluntary disclosure. Every state has a voluntary. It's an agreement. It's a contract, effectively, where you and the state agree on the facts, and you come to an understanding on what liability you may face for your historical work inside that state. It's called a voluntary disclosure agreement. We have a great voluntary disclosure service. Lots of people have them. I think ours is, world class, and I would certainly recommend that to you. But it's the kind of thing that you want to take seriously, because every state has this. They're kind of uniform. So almost every state waives penalties, lets you file maybe one big return for all of them, maybe not. Maybe you have to file one separate return. Maybe they'll let you file an annual return. All that is negotiated. And then they shorten the look-back period. I talked to you about a statute of limitations. A statute of limitations is a law that limits how far back a state can look at your activity. Well, that only applies if you have a license. If you don't have a license, some states there is no statute of limitations. There is no limit on how far back they can look. Under a voluntary disclosure agreement, the states, they voluntarily agree to limit how far back they will look. And this can be a very, very positive thing, although it doesn't probably seem that way at the time, because it's usually multiple years. But it is almost always less than what you might have had to do had you said to the state, yeah, I started doing business 14 years ago. Because 14 years ago is a long, long time. That's a lot of sales. We have a extremely robust business license system, and it's sales tax registration, all different kinds of tax registration, business license registration. This can be a very simple way to get registered in lots of different places, effectively with providing the information one time. It's important to only be registered where you want to be registered, or no, let me say that differently. It's important to be registered only where you are required to be registered. Don't rush out there and get a license everywhere, because you might not have to. This is the law, and either the law applies to you or it doesn't. And if it doesn't, think long and hard before you subject yourself to someone's jurisdiction. Preparing and filing sales tax returns. We have a thing called managed returns, and it comes in a variety of different forms. We have a very robust partnership with accounting firms, but it's a way for you to offload or outsource the actual return filing process. It all comes with payments as well. If we file your returns for you, we will make the payments for you as well, which is a great time saving on your part, because then the obligation to have it done right is on us and not on you. So, Courtney, do we have any questions?
We sure do. Thank you, Scott, for going through all of that. And thank you, everyone, for submitting such great questions. So let's dive into a few of these. This is a good one. What's the difference between sales and use tax? So we talked a lot about sales tax and economic nexus. Where does use tax come into play, and how do you determine which applies?
Thank you so much. That's a great question. I don't think I've used the word use tax in a way that's actually have helped anybody. Use tax. So these are two separate taxes. We call it, so when you talk to people, and I do this all the time. I talk about sales and use tax, and I say it so quickly that if you're not paying attention, you might think I'm talking about the same thing, but they're not. The sales tax is a tax whose collection obligation is imposed upon the retailer, the seller. And some states it's a dealer, some states it's a seller, some states it's a retailer. Every state uses a different word for what you are. But in every state, what that is a legal obligation upon you to collect and remit the tax. The use tax is a tax that's imposed upon a buyer. So if I go out online today and I buy something from somebody and they don't charge me sales tax, and it's taxable where I live, I have a legal obligation to file a use tax return with my Department of Revenue and remit the use tax, which is equivalent. In some states they call it the compensating use tax, which means it compensates for the sales tax that should have been collected. Now, when you get audited, all the time I've talked about auditing on this presentation, I've never told you what they're going to do, because I've been talking about nexus. So an audit for nexus is different from an audit, a normal audit, a sales and use tax audit. In the nexus audit, they're going to assess you sales tax on the tax you should have collected from your customers in their state. In a normal sales and use tax audit, they're going to look at your purchases. They're going to look to see what you bought from people to see whether or not that person charged you sales tax. If that person didn't, they're going to assess you a use tax, a tax based upon your usage of that item, property or services, if they're both taxable in that state. And use tax is still the vast majority of tax that gets collected in a normal sales and use tax audit.
Great. And can you talk a little bit more about what are some things that businesses need to pay attention to when leasing or moving equipment across counties or states, especially as it relates to use tax?
I think we're down to one state now that, let me say it differently. Every state in the country but one imposes a sales tax on the lease stream, assuming they tax leases at all. Now, there are states that don't tax leases at all. It's extremely rare. If you're doing business in a state, you take property into a state that taxes leased items, they're going to expect you to collect the sales tax on the payment made by the lessor for the time period that leased item is inside their state. And this is it's actually a great question, because on January 1 of this year, Illinois started taxing lease payments. Before that, they exempted lease payments, but taxed the purchase of the lease item. So the lessor would pay sales tax when they bought it, but wouldn't charge sales tax when they leased it out, which was just fine if the product only stayed in Illinois.
Mhm.
But if the product moved outside of Illinois, every other state in the country expected the lease sales tax on the lease payment. So if you were an Illinois lessor, you were paying sales tax when you bought the item, and then when that person moved it out of state, you had to charge them sales tax, which meant you had to have a license in those states. So one of the things about leasing is tangible personal property. If you are a lessor and you have products that move or products that you lease to somebody in another jurisdiction, that's your property. You own that. That's tangible personal property that you have inside of a state that creates physical presence for you, automatically creates an obligation for you to have a sales tax license. So the leasing industry is very complicated, and it's been this way forever. The economic nexus didn't change this. This has always been the way with the leasing industry. The rest of the world now is caught up with the complexity that the leasing industry is always faced. But tangible personal property, move to another state, the state's going to assume you have physical presence and assume you need to have a license and assume that someone's paying you to have that property inside the state, and as such, you should be collecting sales tax on that.
Okay, good stuff. Good stuff to be aware of. Next question, we talked a little bit about registration, and you might have covered this, but this question specifically asks, if we've registered for sales tax in a state, could that registration also trigger other tax obligations like franchise tax, income tax, or Secretary of State registration?
Yes, it certainly could. Now, not every state, I'm going to choose Secretary of State answer first. Not every state has an automatic tie between sales tax registration and Secretary of State. And I am no expert on Secretary of State. All I know is that they don't necessarily go hand in hand. Sometimes they do, but they don't necessarily go hand in hand. And the same thing with franchise taxes. In franchise tax is a tax that exists in a few states. It's kind of a variation of an income tax, and then corporate income taxes. But we could also be talking about personal income taxes. Having a sales tax license puts you, most states have, what's the phrase they use to describe? And I can't think of it right offhand, but there's a phrase that states departments of revenue use to describe a system. So what they want to have a computer system where they collect your information one time. And so you've got a master account with a state, and then you have sub accounts based upon the type of taxes that you're subjected to. And in that situation, sometimes they build it from the top down, sometimes it gets built from the bottom up. So you go into a state and you get a sales tax license. Well, you complete a business license application. And effectively, you're building this from the top down, and then you're going off in one direction. Well, one should always presume, and this is where you need really, really good tax advice. One should always presume that having some form of license registration in a state will be looked at by the states for all the taxes that they have. Now, it doesn't mean that you're going to have a tax obligation. Doesn't mean you're going to actually owe any tax. Remember, most corporate income taxes are net income taxes. And as such, you have to have net income, which is why you really, at that moment of time, need professional advice on whether or not you have to file a return, whether you're subject to the tax or you have to file a return, and whether or not you owe any tax whatsoever. But yes, you should always be concerned about that. But there really isn't much you can do about it, because the law of every state in the United States makes you get a sales tax license once you've exceeded a certain threshold.
Okay, great. Thank you. Let's get through a few more. How does economic nexus work in states that have both a transaction threshold and a dollar threshold? Do businesses have to meet both or just one? And I think it depends on how it's phrased, right?
Yes, that's a great way of saying that. In the majority, so there's three types of economic nexus states today. There's the traditional, where you have a dollar threshold plus transaction threshold. You have the states that only have a dollar threshold. And then you have a couple states, and actually I think it's only New York and Connecticut, where it is a dollar threshold and a sales threshold. In those two states, Connecticut and New York, you have to meet both thresholds. You have to have more than X number of sales plus more than X number of transactions. In the states where it is just sales, pardon me, it is just literally sales. And it does make it, how many transactions you make is irrelevant. If it is a state that has sales plus transactions, or not plus, or transactions, sales or transactions, whichever number you hit first creates the obligation. So if you're doing business in a state there, it's $100,000 or 200 separate transactions. When you get to 205 transactions, you have an obligation to get a sales tax license, regardless of what the dollar amount of your sales are.
Okay, fantastic. And then maybe one last question here. How much time does a business have to take care of their tax obligations once they've crossed that threshold? And I think there might have been just some recent changes that you told me about in South Dakota with that.
Yeah, and then that's a question that I almost always forget to bring up, and so thank you very much for whoever asked this question. In the majority of states, you get X amount of days. So let's say today is whatever day it is, and tomorrow you exceed the threshold. In the majority of states, and I don't have this information at my fingertips, but this is where that good legal or accounting advice comes in really, really handy. In the majority of states, you have either 30 days or 60 days to get a license and start collecting. There are a couple states, and I'm glad you mentioned South Dakota, Courtney. South Dakota just changed their law this year. Prior to this year's change, it was instantaneous. So if you exceed their economic nexus threshold today, tomorrow you have to start collecting tax. And there are still a few states out there like that. It's a concept that the organizations that states belong to are trying to get them to change, because it's just impractical. If not it's probably impossible and certainly impractical to start collecting sales tax tomorrow for a threshold that you crossed today. There are two states, Illinois and California, that have rolling quarters. And so theirs is, instead of going back a calendar year or the preceding calendar year, it's 12 months based on, it's four quarters, and the 4 quarters roll. So in those states, you probably have, there's less of a look back, because it's a rolling quarter thing, and it's four quarters. But yes, in some states you have 0 time whatsoever. In some states you have up to 60 days.
Awesome. Fantastic. All right. Well, Scott, I am very happy to have triggered Nexus with you for all of these webinars that we've done over the years. Great job covering this complex information and distilling it down. Just a couple of reminders for folks. Obviously, you'll have access to the recording once this webinar is over. And then I also wanted to mention, if you go to avalara.com and click on the resources section, that really is going to be your best friend when it comes to accessing some of the tools that Scott talked about. That's where you can access our economic nexus self-assessment to see where your business may have triggered tax obligations. And then we also have a slew of other resources there. There's an economic nexus state-by-state guide that goes over some of the most recent changes with state transactions and threshold amounts for economic nexus. And then it also dives into some of the other state-by-state guidelines for the different types of nexus that Scott mentioned. So again, Scott, thank you so much for sharing your expertise. And for everyone who joined us today, we really appreciate your time. Hopefully you found this information valuable, and we'll see you for one of our future webinars very soon. Thank you.
Thank you.